Mark Sinatra, welcome back to Acquiring Minds.
Thank you, Will Smith. Appreciate it.
Mark, you're a business buyer and now a two-time Acquiring Minds guest. You were an early guest back in late 2021. So you have acquired and grown and exited businesses. You are an investor in other search deals. So broad experience in acquisition entrepreneurship. And your day job is running Aspen HR. Aspen HR is an outsourced HR provider. So you have a lot of frontlines experience with the people side of things. And as comes up time and again on this podcast, small business pivots around this topic, people. So we're going to dive into some specifics and your expertise around some of these HR and people questions in small business for acquisition entrepreneurs. But first, Mark, refresh our memory a little bit. Give us a little bit more of a bio than I just did on you, please.
Yeah. No, thank you, Will. Like you said, I pursued a traditional funded search shortly after getting out of business school. For many of the folks listening to this today, the big appeal was to run a company without really taking the risk or without having the idea that I was uber passionate about to have started one at the time. And I felt like the search fund model was the most direct path for me to get into that CEO seat. So I pursued that path. I searched for about a year and a half, and this was during I would say 2007 to halfway through 2008 time period, and then was lucky enough to cobble together a transaction to acquire a company called Staff One HR, which was a provider of outsourced HR services, otherwise known as a PEO, to small, medium-sized companies. The company was based about 2 hours north here in the Dallas area. Was really good representation of, I would say, a lifestyle business where, the owner had kind of built it up, was looking to retire, no succession plan, no liquidity plan. So on paper, had a lot of the attributes that any search fund operator would want to see in an acquisition. I will say, and we'll go into this a little bit later, there were certainly some attributes of the business that were significantly, I think, under-professionalized. That kind of led to me spending a lot of time the first, I would say, 3 years or so, really kind of fixing and trying to professionalize and trying to kind of gear it up to be more of a growth company. But that said, we actually got it to a point, I would say, like 3 years into the deal where I felt, okay, now we can really start to grow organically, pursued a path of mostly organic growth for really the 6-year period from really 2011 to 2017. And on top of that, made 3 small add-on acquisitions towards the end of the hold period, which we'll get to later as well. Kind of package everything up together, and we sold it to our largest privately held competitor in 2017. That was backed by a couple large private equity firms that were doing a roll-up of the industry. We were the second to last acquisition that they did. Prior to them, about 12 months after they bought us, they then, in turn, packaged everything up and sold everything to a public company in our space. And so I left about 6 months after that acquisition, and then, like you said, started kind of dabbling in investing in search funds, and currently do that now with my friend and business partner, Matt Zucker, who I've known for long time, since the early days of Wharton. And so we invest in search fund deals out of the ETA equity fund that we run. So
great. Thank you for that, Mark. And so and then Aspen HR, how did you get involved in this business?
Got involved in Aspen HR through some mutual industry connections, and I did make an investment in it, but it was started about 5 years ago, and I got introduced really in the very early innings of the business, but it was after they had started, and they were looking to really kind of grow, scale, professionalize the business. So in some ways, actually, some very similar elements to kind of the search fund thesis, and we've pursued a path really since then of significant or organic growth to the point where we were recognized on the Inc. 5000 list last year as the third fastest growing PEO in the country. This year will probably be up on a top line basis 50%. And really, I think what's leading to that is just, our white glove service model and our keen focus on our sandbox, which is really serving, the investment management segment. So we serve a lot of like VC funds, private equity funds, and their portfolio companies. And I think part of our partnership as well, like we're starting to really kind of dive in more into actually serving search fund operators as well.
Mm-hmm. Great. There will be a link to your first interview so people can get your story in full there. So we're going to move on from that. And let's dive into some of the themes that we decided we'd talk about today. First, diligencing the people aspect of an acquisition. So this is something that comes up a lot, looking for key men and women risk, making sure that they stay, that employees in general stay, pro formaing people coming to you on day one for raises. I mean, there's so much of this is about the team that you're about to inherit and lead. What do you want to let searchers out there know about how to diligence from an HR perspective?
Yeah, I mean, absolutely. I mean, I think it's one of those underrated aspects of diligence that, when you think about due diligence in a traditional framework, you would think about, Q of E, legal. If it's a tech deal, you do your tech diligence. If it's a healthcare deal, you do your healthcare diligence. But I feel like the HR component really gets overlooked. And if I had to kind of boil it down into, I would say, 3 areas. One would be HR compliance. The reality is a lot of these search fund companies have never sold before, right? HR is very, very rarely will they have a dedicated, HR professional or HR manager that's an in-house employee managing that function. It's usually a function that's shared, really among could be the owner, the controller, maybe an office manager. So I'll typically see a lot of improvement just to professionalize, what the company is doing from an HR compliance perspective, ensuring that there's proper classifications of employees between full-time, part-time, 1099, W-2, very common issues that pop up that sometimes aren't really caught in the traditional, I would say, workflows of due diligence that we'll see. The second area would be, like you said, key employee transition risk. So, really understanding, to kind of taking away besides the seller and the owner, but, who are those other folks that at the end of the day, really drive the business, right? And not just looking at an org chart and inferring from that, because that often is not reflective of reality in terms of, who do those key customers really rely on, for questions and answers on a regular basis. And, how is that person, compensated relative to the market? What's their tenure? Are they engaged? Are they happy? What's their tie to the owner? If the owner's going to leave, will that key employee leave as well? Are they going to stay? To the extent, and this is the hardest part of due diligence, to the extent that the searcher, or the buyer can start to build and form, that trusted relationship during the due diligence and deal process, the better it's going to serve them in the future in terms of first, understanding, well, is this key employee going to stay on or not? And hopefully, they will stay on, and you get a good sense of, what motivates them, what drives them, what do they like about, the current company? What don't they like? What do they want to see improved? Really asking a lot of questions to, seek their input early on is, I think, extremely, extremely critical. So I would kind of classify that second bucket again as, transitional HR risk, that is really critical. And I think it's really, it doesn't matter if the company is a service company, software company, healthcare company, or even a manufacturing company, right? All of these companies at the end of the day, have key employees that the seller and owner, rely on for, to drive, the day-to-day, operational part of the business. And I
Hmm.
would say the third part is really, assessing kind of going forward. Do you have the right team in the right seats, doing the right thing the right way, right? So more like the strategic HR element. And I don't know if you've had folks on this podcast before talk about different business growth frameworks such as, EOS, Entrepreneurial Operating System, or Gazelles, through the Vern Harnish method. But the bottom line is, and this is true from my experience, it is imperative that you have the key roles in the company at all levels, but particularly I would say, mid-level managers and then your executive team filled with people who are obviously technically competent for the role, but also culturally competent as well. And it's a very strong culture fit. And if you can firmly kind of check those two boxes, then it's going to make your job a heck of a lot easier as the CEO to run and grow that company and to have time to focus on the right things to drive value for the company. I found from my experience, and this will dovetail into a topic we'll talk about a little later, that it took me honestly too long. I would say it took me a good like 3 years to really kind of figure out the right formula and to have those right seats filled with the right people. But I can tell you, once I was able to do that, that enabled me then to then focus on, those add-on acquisitions, to focus on growth initiatives and all the fun stuff that really drive, significant value in the company. So kind of take it a step back. I think, again, those are the three areas of what I would call HR due diligence that are extremely critical to evaluate in a potential transaction. And oftentimes you're not, as a buyer and as a searcher, you're not going to be able to do really any dive or deep dive into those areas until you've probably made some progress in the transaction, because the owner is likely going to be pretty guarded initially, certainly post LOI, even in the early stages of providing you access to
Right.
some of their key leaders and key employees. But what I've found is, you as long as you continue to do what you say you're going to do in the transaction, which builds trust, right? And as you continue to build that trust with that seller, and you continue to make progress through different key milestones and gating items in the transaction, the greater your probability is that you're going to be able to, get good quality FaceTime, group FaceTime, even better one-to-one FaceTime with those key employees. And that is going to be really, really key again to giving you the confidence that, okay, these key new hires or I'm sorry, these key employees are going to stay on, post acquisition, or conversely, maybe they're not. But either way, you're going to have clarity in whatever direction that's going to go in.
I want to hit one of the next themes, which is another thing that comes up, of course, in due diligence, is customer concentration. Well, I shouldn't say customer concentration. I should say being aware of your biggest customer. That big customer might or might not represent too much concentration. But even if it's not, even if you've got a nice distribution of your customers, you're still going to be hyper aware of who your biggest ones are. You have lost your biggest customer. This is something that you've experienced. Tell us that story, and how you dealt with it.
Yeah. I mean, it's definitely something that I'll see quite often when we're evaluating investing in search fund deals, and that's partly just due to like the kind of fairly relatively speaking small nature of the deals, right? Companies with 5 to 20 million revenue. So it can be certainly solved for sometimes in terms of how you structure the transaction. I think in my case, when diligencing the deal, the largest customer was actually only about 10 to 11% of total revenue, which still is like higher than what you would want to see, but nothing that was, I would say, alarming per se. But a couple things happened subsequent to close. One thing that happened was really a macro headwind of just the kind of a deep recession. And so, that really hindered our ability to have as much organic growth as we expected. So didn't sell as much as we thought. And then coupled with current clients, we had some clients that were just frankly just went out of business, or we had some clients that were reducing headcount, which reduced their revenue. But at the same time, our largest client actually during the recession grew very quickly. It was a company in the property management space, and they were just well capitalized, and they really took advantage of a significant growth opportunity to acquire new properties to manage during the recession. And so, if you just kind of look at it mathematically, like the numerator grew a lot while the denominator kind of reduced. And so, I kind of found myself, a couple years post acquisition with now my largest client, not they weren't 10%, but lo and behold, they were actually 30%, of the business. And it presented us with like a significant risk, from that perspective. Of course, the fact that they grew was really nice, but it's a double-edged sword, right? Because the more they grew, the more risk there was. And kind of looking back at it, despite the fact that they grew so much in headcount, at the end of the day, like at their core, they're very, I would say, kind of relationship based folks. The decision makers and the influencers, at that organization. And unfortunately for us, we had a kind of a long tenured employee who was really kind of at that retirement age. And, unfortunately, like after like, I would say the 2-year period, really wanted to, retire permanently, kind of forever. And it kind of gave us it left a void in terms of, okay, well, we have to really do a good job of ensuring that the replacement for this individual would be equal to or just or even better, right? In all aspects. And the short answer is that I just did not get the replacement hire correct at all. It was just, it was really kind of I would say a misfire on my end where I think I had overvalued perhaps, this individual's, I would say, kind of HR competency and skill set came more from a traditional, perhaps corporate background and not really a small, medium-sized company background. And so the relationship building component wasn't as high as what the other person had that retired. And so as a result, um, the largest client just was really not comfortable at all, with the person who, we had hired to replace. I will say, and I may have talked about this in the last podcast, and so maybe slightly redundant, but real quick, I mean, that whole experience, kind of opened up my eyes to leveraging, the use of personality profiling tools to increase hiring effectiveness, improve hiring accuracy, and I will say, like, I don't think after that experience, I really don't believe I had a misfire to that extent, but
Mm-hmm.
it really did, I think have a negative impact on this client to the point where I remember walking into our building one day and got in the elevator and saw this FedEx guy with an envelope and going to my floor, and I'm like, oh geez, like I just had a really sinking feeling in my stomach that it was going to be some sort of a cancellation letter, and it was. That's what it turned
Wow.
out to be, and that really kind of set the stage for us to really restructure the business and really kind of like showing a kind of a magnifying glass of just making sure that we really understand, the type of employee and executive, that would be value add, to us and to our clients going forward.
So to be clear, this customer of yours who hadn't represented too big a percentage initially, had grown into 30% of your revenue. The person who was servicing on your team, the person on your team who was servicing that client retired. And your replacement that you chose, it was just a terrible fit.
Yeah, I mean, definitely my mistakes. I mean, I don't want to put it on that individual like solely, and there were a couple other challenges as well, which as what we have found is as companies tend to get extremely large, right? I mean, like 1,000+ employees, the kind of the way that you service them, in the earlier days changes, right?
Mm-hmm.
And needs to change, and I don't think we really adapted quickly enough to that. But
Mm-hmm. Mm-hmm.
that's a good summary on your end, though. Yep.
Yeah. And so what to do differently was what you took away from that experience, which is personality test. I mean, you became much more data driven, analytical, scientific, even in terms of key hires. Was that kind of the big
That's
lesson
one
you
of the
took away?
things. Yeah, that's definitely
Mm-hmm.
one of the biggest takeaways. I would also add as well, though, that we went to more of, I would say, a decentralized approach to managing the clients in general, right? And so there's always like a double-edged sword of having. Do you have a single point of contact to make it kind of easy, seamless, for the client, or do you have kind of a team of people? And we went to more the latter because we felt that sticking with like the single point of contact model would have presented us with a similar risk where in the future of being kind of too concentrated in of risk in that the quality of that relationship between the single point of contact and the client. And so kind of decentralizing that among I would say like 3 individuals on a team or pod, if you will, was something that we went to afterwards that I think really helped mitigate that key person risk going forward.
Great, Mark. Thank you for that story. The One of the things that I think you mentioned, but I know from your experience over those 9 years was that there was a lot of organic growth, but you did do a couple of add-on acquisitions, and you also see into search deals of other acquisition entrepreneurs wanting to buy and then acquire more, and that certainly is something that you hear about a lot here on Acquiring Minds. People doing that, and it's one of the exciting prospects. It's like once you've done your first deal, you've learned how to do a deal. If you bought kind of a good platform, then maybe these second and third deals are even easier. You're now part of the industry, so you're not some outsider knocking on doors saying, "Hey, can I buy your business?" I mean, so it should only get easier. Now, that's probably naive, and a lot of people have said that their whole plan is to buy the first business, then the second, then the third, then the fourth, and they got in there and realized how unrealistic that was. However, it's still a playbook. It's still certainly done. What are your thoughts on how searchers that you talk to should think about add-on acquisitions and how you have in your own business?
I mean, I think in general, inorganic growth, add-on acquisitions can be a fantastic lever to grow and to increase enterprise value, particularly in industries that are fragmented industries where the barriers to entry may be, I would say, like low to moderate, but the barriers to scale are high. And so as a result, you've had a lot of companies that kind of plateau, at that, anywhere from 1 to 20 million in revenue. And they either can't get beyond that or they don't want to, right? Because oftentimes, an entrepreneur can actually be the most risk averse person when, they get their company cash flowing to a really sustainable, predictable level, right? And so then it
Yeah.
starts to kind of plateau. And those can be really interesting and very creative acquisition opportunities, for a search fund, operator. I think the way that I approach it, so I did 3 add-on acquisitions. 2 of them were extremely creative at a weighted average, Actually they all were creative, but I would say two were very successful. One was I would say like average. But across all three, the weighted average EBITDA multiple was actually like 2.7. Now that was synergized. That was post synergies.
Mm.
Um, but we sold for double digit EBITDA multiples, so you can see like there's significant arbitrage there. But it was a strategy I didn't really pursue until, I would say like at least 5 or 6 years, of running the business. I wanted to make sure that we had a strong foundation first where we could operationally do a great job with integration and absorbing those add-on acquisitions, and that we were showing some, sustainable, consistent double-digit organic growth. And so once we were able to check those boxes was when I felt comfortable, actually pursuing inorganic growth as a strategy for us. And so one of the things I did was, I got really involved in our industry trade group, even to the point where, I served on two different boards at different times. And that gave me really incredible, I would say, visibility and profile within the industry so that, when I did my reach outs to potential target companies, it was often a friendly reach out, just as, hey, I'm just representing the industry trade group. Wanted to kind of give you a sense of, what transpired at the last meeting and just, kind of trade insights. And I felt like most, if not everybody, was very receptive to that. And of course, like invariably, like, the conversation at some point would turn to whether or not, the company was going to be receptive to us, engaging in some high level conversations about us acquiring them. But I would say like that use of my time was really kind of high return on in terms of being able to just build relationships, build my profile, and just build credibility within the industry to give me kind of an early look at acquisitions that were sourced by myself proprietarily, or maybe even through a broker or to a banker. So it turns out, we closed our first the first add-on acquisition was 2 years prior to our sale. The second one was 1 year, and the third one was actually 2 months prior to our sale. And they were all add-on acquisitions where it was essentially buying a book of business. One of them, the second one was a little larger, so we did inherit and retain most of the employees. I think there were 9 employees, not 8 or 9 employees that we retained from that deal. But ultimately, it was still like I think all three were pretty much like buying books of business. And I really like the timing in terms of how, we kind of planned it out in terms of, the add-on acquisitions being done and then our exit, because it allowed us to, when we kind of went to market, we could show that we did these deals and, post deal, post transaction, we had, very high retention rate, of those clients. And so it was a real, I would say, compelling, credible story to potential buyers that we could say, okay, we've grown organically, continuing to do that, but now we're also credibly growing, inorganically. And it was a
Hmm.
good story. I feel like, there's obviously different types of add-on acquisitions, right? You've got your book of business acquisition, which is what I pursued. I feel like, those can be great deals in like the second half of your hold period before you exit, because the risk is if you do those books of business deals a little too early, and you don't have a good model to really retain those clients, you could end up attriting, a good portion of those clients by the time you exit the entire deal years down the road. Um, on the flip side, if you're looking at an add-on acquisition that could give you access to, a wider, deeper pool of talent, so kind of more of a quasi acquihire, or an add-on acquisition that'll give you access to a new market or to new product, new service, I feel like those acquisitions, to really get the biggest bang for your buck, are best done in if you can, in like the first half of your hold period, so that you can do the level of integration you need, and to extract the amount of value add synergy, revenue synergy, if it's a new product or service or new geographic market, or human capital synergy in terms of having access to, like I said, a wider, deeper pool of talent, because there's some latency involved, right, in all of these deals, where the work that you do day in and day out may not flow through and show up in the P&L until, like, several months later. And so you want to make sure that if it is an add-on acquisition like that, that you're going to do that kind of well before your exit time horizon, so you realize the value of that acquisition. But if it's a book of business, like I said, I feel like that can be done certainly in like the second half of the hold period. So those are just my thoughts on and my experience with doing add-ons.
Well, you mentioned integration, and I guess when it's a book of business, those are kind of integrated kind of pretty seamlessly, because you're just plugging in those customers. But for businesses or acquisitions that are not just book of business acquisitions, integration is the trick. And sometimes you don't necessarily need to integrate. You just kind of have two businesses that might be complementary or adjacent or even in the same space, but you decide to keep them segregated, kind of, or as different two different entities. Is there any way to generalize here some best practices, or is it so case by case that is hard?
Yeah, I think there is. I mean, I was like, 'cause I've been on both sides, right? 'Cause so, like, when I sold, the search fund company, we were essentially an add-on, right, to a much larger
Mm-hmm.
platform. So I've been on both sides here. Now, the difference though is, when I sold the search fund company as the add-on, that was, I guess, about a year. Yeah, it was a year before that entire company sold. But I really thought that the buyer in that case did a really, really good job of approaching the integration. So their approach to integration was to really identify what I would call, like, if you look at a 2x2, like the low hanging fruit that would be fairly easy to synergize, but would not have any impact on the clients, right? So that kind of like box, like, was like tier one priority. An example would be certain back office functions, trying to realize some efficiency, synergy, and finance and accounting, corporate HR, things like that were kind of like fairly easy to realize that synergy of. Maybe they had, they were much larger scale, so they had discounts on things such as, their banking relationship or other vendors. And so kind of absorbing us there, as long as it didn't have an adverse impact on the client experience. So conversely, they were very hands off in a lot of other areas, in terms of even our brand. We were able to still sell, underneath our existing local brand, for a pretty long period. I would say up to, I think, at least 24 months post close. And so that enabled us to then, you know, I would say, show good organic growth post acquisition, and to have high client retention as well, because the client experience, in terms of who do they talk to for day-to-day questions, who they talk to for payroll, what kind of technology platform were they using, and were those workflows going to change? None of that changed whatsoever. Obviously, I mean, it did at some point, but it didn't change, I think, for at least 2 to 3 years, post acquisition. And so I thought, again, the acquirer of my search fund company did a really phenomenal job at, like, just identifying those easy, quick wins that were not going to have any impact to revenue, and then just being, I would say, fairly hands off and supportive in terms of initiatives that would be positively impacting revenue.
Mark, I know I'm looking at the clock here, and I know you have a hard stop, and so I need to let you go. But there are going to be a lot of people listening to this who are working on deals. If they are interested in talking to you about investing in their deals, should they come to you?
Yeah, definitely. If for traditional funded searchers that want to learn more about us, definitely check out the website, which is etaequity.com for the HR stuff, PEO stuff, HR Diligence. That company is called Aspen HR. We've helped several searchers, with their PEO and HR evaluations. My email address is mark with a K at aspenhr.com. And I appreciate you being cognizant of the time. I mean, I do have a 1 p.m. Barber appointment, which you can probably tell. So definitely don't want to miss that, of course.
And Mark, just to be clear, should self-funded searchers reach out or just traditional search fund folks?
Any and all searchers. I will say for terms of in just purely investing, as of this time, we're really kind of focused on the traditionally funded asset class. But I talk to self-funded searchers all the time, in just the context of just answering questions, providing any advice, particularly when it comes to like kind of the HR side of those deals. So really just happy to talk to anybody looking to buy and acquire and run a business.
Great. Well, Mark, thanks for coming back on Acquiring Minds. I will let you go and get those hairs cut, and we'll put all of his contact information in the show notes. Thanks very much, sir.
Thank you. Thanks, Will.
I hope you enjoyed that interview. Make sure you subscribe to the Acquiring Minds channel below. We are now publishing twice a week, so tons of new interviews and stories to come. Stories that will help you along your own path to acquiring a business.